Welcome to Money Matrix, where we break down the world of cryptocurrency to help you build lasting wealth. By early 2026, the storm clouds are gathering. The signals are no longer ambiguous. To fight inflation that just won't dip below 3%, central banks have hiked rates to over 5.5% in the US and 4.5% in Europe. For 4 straight quarters, corporate earnings have been revised down. The yield curve has been inverted for a record 28 months, and economic indicators are falling at their fastest rate since 2008. The consensus is clear. There is a 78% chance of a global recession. The question isn't if it's coming, but how bad it will be. Surviving this financially requires a new playbook. First, let's talk about cash. Cash is no longer trash, it's oxygen. The average household is entering 2026 with only about 2 months of essential expenses saved up. That's not nearly enough. History shows that during bad recessions, you might be out of work for a long time. The single most powerful way to protect your wealth is to have an emergency fund covering 12 to 24 months of your essential spending. For a typical middle-income family, that means having $60,000 to $120,000 in a high-yield savings account or short-term treasury bills. Anything less is just wishful thinking. Next, debt has become radioactive. Credit card rates are averaging nearly 25%, a record high. Carrying high-interest debt into a recession is a financial death sentence. With layoffs already hitting major sectors like tech and finance, you must eliminate any high-interest debt now. And those home equity lines of credit, they're a trap. Rates are now over 9.5%, and lenders can freeze them without warning, just like they did in 2008. If you have one, consider freezing or closing it immediately. Your investment portfolio needs a major rethink. If you're within 5 years of needing to withdraw money, the old 60/40 stock-to-bond mix is now dangerously aggressive. A big market drop early in retirement can permanently wreck your financial future. This is called sequencing risk. A recession-proof allocation for 2026 looks more like 25 to 35% in global stocks, 40 to 50% in high-quality government and municipal bonds, and 20 to 30% in cash or inflation-protected securities. Remember, the real risk in volatility, it's the permanent loss of your money. After a 15-year drought, fixed income is back. 10-year Treasury yields are attractive, offering security when stocks fall. Now is the time to lock in these rates. A ladder of individual Treasury bonds maturing over the next several years can provide a stable 4.4% to 4.8% return with zero credit risk. For high earners, municipal bonds offer an equivalent of over 6.5% tax-free. When it comes to stocks, focus on survival assets. Think dividend-paying companies in sectors like consumer staples, healthcare, and regulated utilities. They aren't exciting, but they have a history of outperforming the market during every recession since 1970. Don't forget about hard assets. In this environment, gold is not speculation. It's insurance. Central banks have been buying it by the ton. Historically, real assets have done extremely well when central banks pivot from raising rates to printing money again. A small 5 to 10% allocation to gold or commodities acts as a hedge. But be wary of trendy, illiquid investments like private credit funds. Many are now defaulting at rates we haven't seen since 2009. In a recession, liquidity is worth more than a high yield. Finally, you need to diversify your income. Don't wait until you've lost your job. The gig economy isn't the safety net it once was. The most resilient side incomes are based on specialized skills. Think consulting in your field, teaching online courses, or creating tools for small businesses. Every extra $1,000 you make each month significantly reduces the pressure on your retirement savings. Understand this. The coming downturn won't be like 2008 or 2020. We're facing a unique mix of stubborn inflation and falling demand, a stagflationary environment that can punish both stocks and bonds. The government's ability to bail us out will be limited. The households that thrive will be the ones that prepared in advance by eliminating debt, building up cash, diversifying income, and repositioning their portfolios for a new reality. Recessions don't create danger, they reveal who was prepared. The storm is on the radar. The only question left is whether you've battened down the hatches. Thanks for watching. If you found this valuable, please like and subscribe for more insights on how to protect and grow your wealth.